Welcome back to the Noob Selling Options channel. I am absolutely pumped to have you here for today's explainer because honestly, it's a massive one. We're zeroing in on the AI Fortress earnings, and then we're breaking down a highly tactical, high-probability meta trade setup that's formed right in the aftermath. So, if you love extracting premium from wild market overreactions, you are absolutely in the right place.
But hey, before we dive into the charts, remember our golden rule here. Like, subscribe, and let's capture this premium. Consider hitting those like and subscribe buttons as the little premium you pay for getting this high-quality, actionable setup delivered straight to your screen. It helps the community grow, and it makes sure you never miss out on these structural market breakdowns.
Here's our roadmap for the explainer today. We're going to start with the AI Fortress earnings, check out Meta's post-earnings plunge, map the drop zones, dive into the 59/600 bull put setup, and finish up with our exact trade execution strategy.
All right, part one, the AI Fortress earnings and Q1 performance. So let's look at the numbers because honestly, they're staggering. We're seeing impressive year-over-year revenue growth across the board that completely validates the whole AI narrative. Amazon pulled in $143.3 billion. That's a 13% jump, largely driven by AWS and generative AI workloads. Then you've got Alphabet sitting at $80.54 billion, up 15% thanks to massive cloud momentum and some serious margin expansion. And Meta, they absolutely crushed it with $36.46 billion, an incredible 27% growth fueled by a highly efficient AI-recommended advertising engine. The big takeaway here, this isn't just hype. All this massive AI infrastructure spending is translating into real, tangible top-line momentum.
Moving on to Section 2, Meta's post-earnings plunge, or as I like to call it, the CapEx freakout.
Now, this is where things get really interesting. There's this huge disconnect between Meta's phenomenal earnings beat and how the stock actually reacted. I mean, on one hand, they blew it out of the park. Depending on the segment, revenue beat expectations by jumping 27% to 33% year over year, and earnings per share skyrocketed to $10.44. Just absolutely phenomenal numbers. But on the other hand, management raised their 2026 capital expenditure guidance to a massive $125 to $145 billion to aggressively build out their data centers. And Wall Street? They basically threw a short-term tantrum. They completely ignored the fact that these are the exact investments needed to build the long-term AI fortress.
And that little CapEx freakout brings us right to this number, $625. Meta violently gapped down from a closing price of $669, dropping straight into that $625 to $635 range pre-market. Just a total plunge. But hey, as premium sellers, you and I both know what happens when the technical landscape shifts this violently, right? Implied volatility shoots through the roof, and that means options premiums get ridiculously rich and expensive. That, my friends, is exactly where we find our edge.
Okay, Section 3, mapping the drop zones and checking our technical support.
So the real question is, where's the stock actually going to find its footing? We've got to draw some clear lines in the sand and walk down the ladder of technical support. Step 1 is Zone 1, right around 625 to 630. That's the initial battleground, the S1 pivot support, where it's going to first try to catch its breath. Step 2 drops us down to Zone 2, from 594 to 600. This is our deep structural support. And finally, if the market goes into full-blown panic mode, Step 3 is Zone 3, sitting tightly between 570 and 575. Think of that as the capitulation floor, that heavy accumulation basement we saw back in early April.
Now, I really want to laser in on that middle area, Zone 2. This deep structural support between 594 and 600 is literally the bedrock of the AI fortress. Why is it so strong? Well, it's fortified by two massive defense lines. First, you've got a huge psychological barrier exactly at that clean $600 century mark. And right below it sits the 200-day exponential moving average at 594. Anchoring our setup near here is brilliant because it forces the market to chew through incredibly heavy institutional buying interest before your position is ever really threatened.
Which brings us nicely to Section 4, the 590/600 bull put setup and tactical volatility.
This deep support builds directly into our highly tactical trade setup, allowing us to extract premium from the market's overreaction. We're constructing a bull put spread to perfectly balance income with safety. For our short leg, we sell the 600 put. That's our income driver, intentionally anchored right at that massive psychological barrier. Then, for our long leg, we buy the 590 put. That acts as our structural defense, strictly capping our downside risk just in case the market completely breaks down through the 200-day moving average.
Honestly, I cannot emphasize this enough. The absolute magic of this setup is the strict risk control. By using a spread rather than a naked cash-secured put, you're capping your max loss at exactly $10 per share, minus whatever rich premium you collect when you enter. It perfectly manages your delta risk. It keeps your capital safe and protected, even if Wall Street continues to punish Meta's spending narrative all week long.
All right, last but not least, Section 5, Trade Execution Strategy and Navigating the Open.
Look, picking the right strikes is only half the battle. Navigating the psychological warfare of the open is the other half. Here's your actual execution strategy for tonight. First off, do not rush in at the opening bell. Let the dust settle for the first 30 to 60 minutes. You need to give the true trend time to establish itself. What we want to see is a downward drift toward that 610 to 615 range for our optimal entry. When it dips there and the premium is good enough, lock in that credit while implied volatility is screaming about a total disaster. Once you get filled, your job is basically done. You just sit back and let natural IV deflation and daily theta decay do all the heavy lifting as the panic subsides.
So as we wrap up this explainer, I want to turn it back over to you, the noobs selling options community. Given the technical drop zones we just mapped out, are you leaning towards playing it super safe with a highly defensive strike down below the 200-day EMA? Or are you feeling a bit more aggressive, stepping up closer to 615 to capture that massive opening IV crush? Think about your own risk tolerance and your expiration cycle, drop your game plan down in the comments, and I'll see you in the next setup.